Let's talk inflation. Inflation can be a scary concept that we need to think about. The other day, somebody approached me and asked me the question. They said, "Listen, I'm really hesitant to begin buying property because I'm concerned about inflation." I've heard this. I heard a story recently. He says to me, this person says to me, I heard a story recently about an investment group. It was a syndication, meaning that the GP raised LP equity from multiple different investors, and that property is now in trouble. They brought it 3 or 4 or 5 years ago. They had a 3-year loan on it. That loan has now come due. Interest rates are significantly higher today than they were even a few years ago, and therefore he's unable to refinance the property at the numbers and the proceeds at which he needed to or was expecting, and he is not going to be able to hold on to the property. He's going to lose their money, and the investors are going to lose their money. And this person was very concerned that inflation is going to remain constant at the higher elevated levels where it is today, and that there could be problems buying property, promising certain investor returns, and inflation is going to continue to go up throughout the years, and therefore he's going to continue to have troubles with his property. So he didn't want to buy property. And I said, let's slow down just a minute. I said, first of all, you should know that one of the key 5 reasons to invest in commercial real estate is because real estate is a great hedge against inflation. So that's an important concept to understand. I don't want to run through all the different reasons why you should be investing in real estate. We go through that in much more depth if you're interested in the Be Your Own Mogul program, and there's a link in the comments to where you can learn more about that. But let's just focus on one. And it's interesting, which is a hedge against inflation. How is it that real estate is a good hedge against inflation, and how do we know that? So let's start with the first one. How do we know? So in order to know that, you want to back test, which means you want to look historically at how institutional and high quality commercial real estate has performed during periods of high inflation in the economic cycle, focusing just on the American market right now. So you could go back to, and let's just pick a couple of different periods in time. You could go back to what I would say would be the late 90s. You could go back to the mid 80s. And lots of studies have been done. But I believe you need to go back even further. You need to go back further really to the mid 70s, to the early 70s and the mid 70s, when there was an oil embargo and high inflationary cycles. And if you look at that time period, real estate did extremely well. It did well in the 80s and the 90s as well. But I don't think that's a good enough test. I think you need to do all three. You need to look at the 80s, really you need to look at the 70s, 80s, and 90s to get a truly accurate test. And when you look across all three, you see from the numbers that real estate, the growth in real estate, the cash flow coming off the properties in real estate outpaced inflation. And that's the key. Factor number one, in order to beat inflation, it simply means that your cash on cash returns need to be greater than the inflation up for that year. So if inflation is running at 3%, you need to make sure that your property increased its rents, increased its NOI really greater than 3%. It's that simple. At that point, you're outpacing, or at least you're keeping pace with inflation. Contrast that to a dollar bill sitting under your pillow. It's not making any increase. So if the cost of money went up 3% that year, you lost 3%. The value of your dollar went down by that percentage amount. So that's why people often say, and there's videos out there and other people talking about this that are much smarter than me when it comes to economics, talking about continuously, you have to have your money invested during high inflationary periods of time so that you will at least keep up with inflation. You're just breaking even. If you're just keeping up with inflation, you're breaking even, right? The money that you've invested went up 3% and inflation went up 3%. You broke even. So that's very important. So let's talk now that we've shown how, or believing me, that real estate is a good hedge against inflation, and we can prove that through the numbers, let's talk about why that is. How is it that real estate is a good hedge against inflation? I'm going to give you 2 different reasons. One is, I'm going to call it economic, meaning that in times of high inflation, it's very likely that a tenant is going to be able to generate more revenue, more income for themselves, and therefore you can raise rents and you can charge them more because they can afford it. So let's make that a real life example on that. You have a multifamily property. You have rents that are $750. Inflation was a certain amount. You have a certain amount that you want to go up every year anyways. You're going to raise your rents 3 or 4% this year. That's a lot, right? Normally, we always say you raise rents 2%. But if you need to raise rents 3 or 4%, it's even funny. Why do we say, funny, my 20, 25-year history of being involved in real estate, the number in my head is that the CPI index, the cost of price index, goes up 2.3% a year. Don't ask me where we pull that number. Just that's the number everybody runs with for 20 years. And if you talk to anybody who's been in institutional private equity real estate for the last 20 years, really since the 90s or really since the 2000s, they're going to talk about that number as well. Everybody used the same number, 2.3%. Why? Because that was the historical inflation number for the last 30 years, since really probably the beginning of the 80s. Historically, on average, CPI went up 2.3% a year. Therefore, you need to make sure that you're raising your rents at least 2.3% a year just to keep pace. So that's how we run our numbers. If inflation is higher, you're going to need to raise your rent even higher than that. Instead of the average being 2.3, the average is now, or the number that you need for right now, forget the averages, throw the averages out the window. Averages don't matter for you right now in this year. You need to know the cold hard facts. Inflation is going up 4%. You need to raise your rents 4%. Can you do that? Because if your tenants didn't make any more money this year, are they going to be able to afford your rent? You need to look at the income that your average tenant or the average tenant in the area for your kind of property, the economic data coming out of the census or the municipality. What is the average rent, the median income for your area? The reason that real estate's a hedge against inflation in this factor is because wages should be going up with inflation, right? The person employed is going to get paid more by the company, and therefore they're going to have more money to pay rent. That's the simple answer. Now, you might say to yourself, well, there's no guarantee that wages are going to go up. 100% correct. And in fact, nowadays, when you have technology and globalization where so many jobs have moved offshore or technology is making certain jobs obsolete, there's a real concern that wages are not going up consistently like they have in the past. And in some cases, that's a boon for certain companies, right? Companies that are benefiting from technology, AI technology, computer technology, and so on, their stocks of those companies are going up significantly. Why? Because the people who understand how technology is going to impact these companies see it as an opportunity for companies to cut costs. Some of the costs that companies are able to cut is in their staff and their labor because they can replace a human being with an AI bot. So that means that this theory that real estate is going to be an effective hedge against inflation because tenants are going to be able to make more money in their jobs might not be as true today as it was in the past. It's going to depend on where your property is located, the kind of property and the tenant that you have. If you have a very white-collar tenant that has a high skill level at a job that cannot be easily replaced by a technology, you might be more apt to follow that this is going to work. If you're at a property where the tenant base works in the types of companies where they could be replaced, that's a different issue. Look, blue-collar workers working in service-level jobs at your local restaurants and your local Walmarts and such, those aren't easily replaced by technology, right? So their jobs are probably pretty safe. The high-end type of employee who probably doesn't live in an apartment, they probably live in a home, so they're probably not your tenant. They're also probably pretty safe. It's probably that middle somewhere that is more difficult to project. In any case, before getting too deep and down a rabbit hole of economic situations, let's just focus on the fact that real estate is traditionally a hedge against inflation because as inflation go up, wages will go up, your tenants will be making more money, and therefore they can afford to pay more money in rent. That works for retail, for office, just the same way. The office tenant will be making more money because they're going to raise the price of the product or services that they sell because they need to make more, they're going to make more money and therefore they can pay more rent. Same thing with retail. They're going to raise the cost of the goods and products that they sell. They'll make more money. They can pay you, the landlord, more money. That's across the board why we think of real estate as a good hedge against inflation. That's one reason. The second reason I always like to point out that is sometimes overlooked is simply what I call the commodity cost. The new property that they're building down the street right now, again, wherever you are and whatever economic period you're in, that new property has bricks and stones and cement and wood and wiring. It has materials. It has commodity type materials, bricks and mortars materials, real world, real materials that they need to use to build that property. If there's a significant amount of inflation, those products have all gone up in cost. Some more than others, right? A few years ago, there's a real concern that copper is just skyrocketing. Well, if you have any kind of electric wiring in your property, and most of us do, that all runs through copper. If that copper goes up significantly, your costs are going up significantly, at least in the electric cost. So if that property is going to cost more to build, the developer is going to charge more when he sells that property or begins to lease it up. If the price and the cost of that building have gone up so significantly, then the value of your property is also going up. Why? Because let's say that's a brand new property, and brand new properties are going to cost $100 more. Now that brand new property costs $150 more, just simply because of the inflationary cost. Your property that was going to go up in any case in value, because the newer properties are $100, your property is 10 years old, so it sells for $75 relative to that $100. Well, if that new property now sells for $150, well, then you can stay that 10, 20, 30% below the value of a new property. So everything's rising up together. I think of it like a tide, right? The tide's going to raise every boat together. It doesn't matter if it's a big boat, a new boat, or an old boat. Everything's going up together. So too with the cost of a property. If the cost to build are going up, then new property costs are going to go up significantly higher. Your property's already built, but you get to benefit because typically an older property is going to stay whatever percentage you want to choose, 10, 20, 30%, whatever the number is, below a new property. A 10-year-old property in your market was always 10% below, 15% below a brand new property. Great. So if that new property now costs $150, you can go up so that you're 20% less. So I hope that helps. If it's confusing, these are some factors that you need to consider, and they can be confusing to understand. But in summary, two different reasons why real estate is a hedge against inflation. One, what I call economic, because as inflation goes up, wages and prices are going to go up. Your tenants are going to be able to make more money and pay you more money in rent. Second reason, happening at the same time, costs to build are going to go up. Therefore, new properties are going to get more expensive, and your property can raise its value alongside that as well. Hope that helps. Speak to you soon.